Good evening, everyone. I, Sia Sanija from Malot, Punjab, welcomes you all on the behalf of Committee of Financial Market and Investor Protection (ICI) in this webinar today. So today we have two of our speakers for this session, Mr. Prishi Kumar Menon and Mr. Navdeep Singh Bakshi, to enlighten us on the mutual fund and its working and micro and macroeconomic picture under buffer ratio and golden ratio. This webinar is being conducted by the Committee of Financial Market and Investor Protection, which aims at working proactively in the domain of financial and capital market. This committee also prepares suggestions on the various bills, regulations, notifications, circulars, and other documents relating to the financial market for submission to the government and regulators. It also prepares suggestions on various bills, regulations, and it also interacts with RBI, NBFC, SEBI, Stock Exchange, and other various agencies on the continuous basis on the matter relating to financial market and investors' protection. To ensure the purpose of the committee, it also conducts seminars, trainings, and meetings to make it more active and initiate the research studies as well. To start with this session, we have our chairman of this committee, CA Charanjot Singh Nanda, who, along with being the chairman of this committee, also chairs Digital Accounting and Assurance Board (ICI), Committee on Information Technology of South Asia, Federation of Accountants. He is also vice chairman of Board of Internal Audit and Management Accounting (ICI). He is a member of Quality Review Board set up by the government of ICI. He also served as a member of SEBI Advisory Committee on Primary Market and Committee on Mutual Funds, and also represented ICI on SEBI Committee on Disclosures and Accounting Standards in the past. So it is not the all. He is doing great as being a CA fraternity. Thank you so much, sir, for being with us. Over to you, sir.
A very good evening, ladies and gentlemen. I am truly honored to be amongst you on this very nice webinar on mutual funds and its working and macro and microeconomic picture under the Buffett ratio and the golden ratio. Ladies and gentlemen, we have two of the very revered speakers with us, Shri Kumar Menon and Shri Navdeep Singh Bakshi. I also have the moderator of the session, C. Astha Aneja, technical support Mr. Ashok, and Amit, advocate Animesh Singh from the Committee on Financial Markets to assist us in doing this program. Ladies and gentlemen, capital markets of late has evinced lot of interest. I was reading NSE had 8 lakh accounts opened last month. 8 lakh accounts means a lot. The way people are getting attracted to the market to multiply their savings is a red zone. Markets are known for their notorious nature. At times, when you come and invest in the markets, you feel that you have lost a lot of money or substantially the capital is eroded. So now in these 10, we are trying to make our members aware of how they could create value and worth by investment in markets, and more importantly, how to save and mitigate the risk which is inherent to investment in capital markets. Both of the speakers have their entire life devoted to the capital markets. And I want to tell you, capital market is a passion which, if pursued in the right direction, will give you great returns. But if you want to play with it, you get a great kick. Ladies and gentlemen, I am reminded of a couplet which says, "Gar khairat mein milti kamyabi, to har shakhs kamyab hota hai. Gar khairat mein milti kamyabi, to har shakhs kamyab hota. फिर कदर ना होती किसी हुनर की और ना ही कोई लाजवाब होता." If you want to work in tandem to create value and worth, if you want to exhibit to the world that with a small capital, you have created a great empire of yours, stock market is the right place. There are two notions. Number one, लोग कहते हैं स्टॉक मार्केट में लखपति होना बहुत आसान है, provided आप पहले से करोड़पति हो. And the second notion is that if you want to become a multi-millionaire by legitimate means, it is only and only the stock market. So, ladies and gentlemen, I invite you to this great, exciting session whereby you will go home putting at rest all the doubts that may have crept over the years. And more importantly, understand the mantra of creating value and worth, escalating your capital, and more importantly, being a confident investor. I will not stand between two of the revered speakers, but I will, as a parting note, I would like to tell you that do your own research. Do not take much risk. Be disciplined in the market. Don't play on borrowed capital. And more importantly, when you invest, always remember the days are a lot. You need not work on a day and invest everything on a day or lose and make money. Every day, when the sun rises, the market also opens. It's a long phenomenon. This has to continue. So you have to very steadily move ahead perpetually to create value and worth. Thanks. Thanks a lot. I want to thank both the speakers and the moderator who have joined to make our participants great, enlightened, and more importantly, put them at the path to progress. Thanks. Thanks a lot.
Thank you so much, sir, for starting the session with so much energy. So to start the session, we have our first speaker, Mr. Navdeep Singh Bakshi, who is a mutual fund distributor from last 25 years and also a MBA finance. He's currently running his own company named Navdeep Enterprises Private Limited and also his own website, Fundsline, Fundzline, if anybody wants to note, fundsline.com. Over to you, sir.
Thank you, Ji. Good evening, everyone. I think I'm audible. And if anybody has a question, you can write it and I'll be very happy to answer. So good evening once again. Thank you, Mr. Charanjot Singh Nanda, giving me an opportunity. Okay, I can let everybody have a good idea about how mutual funds work. What is a mutual fund? Why do some mutual funds work? Why do some people make a lot of money in this? And why do some people aren't able to make good money into this? So let me start with saying, what is a mutual fund? So mutual fund is nothing but a pool of money. Pool of money given by investors, not the sponsored company. So investors like you, me, and us can put something like 2,000 rupees, 200 rupees, 20,000 rupees, 2 crores, anything into a mutual fund on a single day, on a monthly basis. And similarly, people are also withdrawing from this pool on a daily basis. But this pool is growing for the last many, many years because the returns that are generated by the pool are much, much more than what is available in the market. And that's not the only reason why people are putting in money. Returns, yes. Professional management. Mutual funds invest professionally. They have a professional fund manager. A fund manager has a research team. A research team has analysts who are working day in, day out into which stock is good, which isn't good, what can be done, where can the money be put, what would be the best to avoid. So they have a big team doing this. Let me start with what types of mutual funds are available in India. Let me start with how a mutual fund works. Mutual fund company kya hota? I think I can do it in Hindi also. Is that okay, Astha? Or
So it will be fine, but we have, I think, from South as well, so they might not know.
So what a mutual fund company looks like. So it's a 3-tier system. There are 3 companies involved in what we call as a single mutual fund. First, the sponsor company. So we have sponsors in the field like SBI, that's the State Bank of India, HDFC Bank, Canara Bank, Franklin Templeton, Kotak Bank. So these are the sponsor companies. They just put in the money. Second tier is we have a company looking after the compliance. That's called a trustee company. So we have trustees in there. And third is the AMC, Asset Management Company. So the company that we see in ads, whatever ads we see, whatever a mutual fund does. So we are talking about only the AMC, Asset Management Company. They are the guys who charge a little fee also from the fund. They are the guys who appoint the fund manager. They are the people who are doing all the marketing stuff. And the trustee company looks after the fact that whether the fund manager and the company and the AMC is doing justice to its unit holders or not. So it's a very nice system wherein the sponsor is somebody they are appointing trustees, and trustees are looking after how the AMC moves. So only one company out of three is having a commercial transaction from the investors. They collect money, they charge a fee. That's the AMC, Asset Management Company. Then comes the types of mutual funds. So we have a system wherein the mutual funds are divided into market capitalizations. Market cap is nothing but the number of shares multiplied by the price. So that's called the market cap. Supposing someone has 20,000 shares and 10 rupees is the market price. So 2 lakh rupees is the market capitalization. So if we divide the whole of this listed environment, the whole of the listed system into three major parts. So the company that stands first and the company that stands 100th, 100. So all the companies from the first till the 100th company, they are known as large cap companies. The companies from 101 to 250 are known as mid cap companies. And the companies post 250, that is 251 till 500, are called small cap companies. So majorly we have three layers in the mutual funds: large cap companies, mid cap companies, and small cap companies. After 500, they are called micro cap companies. So similarly, the funds that invest only in the large companies, we also call them blue chips. So the funds that invest in blue chips or the large companies, or only strictly within the first and 100th company, they are called large cap mutual funds. Second, mid cap mutual funds. Third is small cap mutual funds. There is some layover happening in another category that's called large and mid cap. That's a very popular category these days. So everybody would love to have some part as large cap funds and the other part as mid cap funds, because mid caps generally run a little faster. We also have we also have funds called as multi-cap funds. So what a multi-cap fund would do is it will have a minimum of 25% of its money allocated to large cap companies, 25 to mid cap, 25 to small cap, and the rest of the 25 they can divide it anywhere they wish to do. So that becomes a multi-cap fund. There's another category called flexi-cap fund. A flexi-cap fund can have anything it wishes to have: small cap, mid cap, large cap, and there is no compulsion of having any percentage. Post this, we have a little high risk funds, which generally tend to give higher returns. It may or may not be true at times. They are called sector funds. So sector fund would be like a pharma fund is a sector fund. They'll only invest, or maybe 70% of their money, into only pharma stocks. Technology funds, they'll only invest in 70% of their money in technology funds. Similarly, there are some more sectors. Then we have something called as thematic funds. So infrastructure is not a sector, it's a theme. So they can invest in a thematic fund. There's something called as defense fund. There's just fund in the whole industry that's called defense. Now we also have funds like manufacturing funds. So the companies only they are manufacturing in India would be bought under that particular mutual fund. So in this way, the fund is divided into the funds are divided into the way they work, the way they pick up stocks, and accordingly, I would say the large cap funds are generally lesser riskier than the mid cap funds. Mid cap funds are less riskier than the small cap funds. Small cap funds are less riskier than the sector specific fund. But in case you have an idea, in case some investor has an idea about the sector, supposing someone is close to the pharma sector, someone is working as a high level person in a technology sector, someone knows about PSU sector, public sector undertakings, he has a fair idea of what the companies could do, they can always buy that sector. It's okay to buy the sector, but it's little more riskier, and I would suggest you should have an advisor for this, a mutual fund distributor for this, who can guide you in some manner as to how much allocation to be put into such high risk funds. If anyone has any questions, you can just write it. I can answer them accordingly. So I was talking about the three layers of the company, three tiers. So the AMC, the asset management company, is dealing with R&T, that's called registrar and transfer agents. The custodians, the ones who are keeping the shares, the distributors like us, and the banks. So the AMC is doing all this work. Next, categorization for a mutual fund would be an active fund and a passive fund. So these days, this passive fund thing is becoming very popular. So what is a passive fund? So you can imagine you're traveling from, let's say, Delhi to Amritsar, and you go by a train. So when you are going by the train, you don't have any control of the speed of the train, but you can always sit back and enjoy. You don't have to actually drive. You are not supposed to know the route. You're not supposed to understand where to stop and how much time to stop, and you can always enjoy. Moreover, traveling by train is much more economical than traveling by a luxury car. But in a luxury car, you can always stop wherever you wish to do. You can always lower the speed of the car. You can always increase the speed of the car. You can have the best of the people sitting with you. You don't need to sit with 40, 60, 70, 80 people in a Coupa. So there are differences. So I would say traveling in a luxury car is like a active fund, and traveling in a train is like a passive fund. The major advantage of investing in a passive fund is its cost. So I hope everybody knows that the average cost of running a train per kilometer would be much, much lower than running a luxury car. It has its own advantages, and it has its some disadvantages also. An active fund can choose any industry. An active fund can choose any weightage given to a particular share. Supposing you have something called as index. So index, we have a BSE 30 and a NSE 50 index. So NSE 50 index would have its own weightages given to shares like stocks like Reliance, Infosys. These weightages could be little over 2, 3, 4%. But in an active fund, you can choose to have your own weightage of the fund. So active funds should prove better, provided you understand that there is value apart from the index. If you think there is no value within apart from the index, all the valuable shares, all the best of the shares, all the good compliant companies are covered within the index, and you don't want to pay the cost, passive funds would definitely work for you. Saying all said and done, these investments should be held for long term. By long term, I would mean at least 3 to 5 years. This is the time you need for these investments to grow. I mean, let's not talk about equities and stocks if the time horizon you have for investments is less than a year or so. They may prove good, they may prove very bad. Very bad in the sense you might even lose some principal amount. So unless you have a horizon which is 3 years plus, I would say 5 years plus, do not enter equity and equity related mutual funds. But if you enter with a long-term horizon and enter in a way that's called SIP, systematic investment plan, I would call it start in parts, SIP. So if you start investing in parts, let's say 10,000 rupees a month, maybe 20,000 rupees a month, someone can afford, they can even put in 1 lakh a month. So when you're putting, let's say 1 lakh in a month and not putting 20 lakhs, 30 lakhs in one go, you are trying to make an average. Supposing the market goes up the very next month, you will have lesser units coming to you. In the third month also, if the market goes up, you will have once again much lesser units coming to you. If the market falls in the fourth month, you will have higher number of units coming to you, because what you're putting is a constant amount and the unit price is going up and down. So when the unit price goes up, the units that you get, that's dividing the money divided by the unit price, goes up and down. So you automatically start making a good average cost for your investments, which is required for a higher profit expectation. So when the market finally goes up and you have a lower average price, you gain. So all in all, let's say you start when the NAV is 10 rupees. NAV is also called as net asset value. You can take it as a price. So if the price of the unit is 10, you start investing. Someday, let's say 5 years from now, 7 years from now, 9 years from now, it reaches 20 rupees. That's a very possible thing. So when the NAV rises from 10 to 20, you make gains on the purchase price of every month. Now, let's say when you started investing, the very next month, the price fell to 980. And post 980, post that month, the price was always above 10 rupees. So 20 minus 980 is going to be the highest value of your profits. So you would make the highest profits if you had bought at a time when the NAV was the lowest. In this particular way, that's called SIP, Systematic Investment Plan. If you keep on investing some money on a monthly basis, there's a very good probability of making a very good profit. And SIP goes from your bank. Another way to do a SIP is called STP, Systematic Transfer Plan. That means you create a lump sum money, you create a plain vanilla fund. By saying plain vanilla fund, I would say a debt fund which generally gives some good returns, a little over your savings bank account, or I would say. From that particular fund, you can always transfer some money to an equity fund. So the lump sum money that you put in becomes the resource fund or the source fund. And wherever your money is going is also called as the target fund. So from the source fund, money keeps flowing to the target fund, and eventually it becomes a SIP. But this is called a systematic transfer plan. So supposing you put in 1 lakh rupees in a debt fund, and that has to offer 4,000 rupees to the equity fund every month. So normally it should have given 25 installments. That's 1 lakh divided by 4,000 should be 25 months. But finally you see this keeps on happening even till the 26th, 27th, or maybe 28th month also, because that 1 lakh is also growing with time, and only 4,000 of the total goes to the target fund. So these are two methods, SIP and STP, which should be used as a way to invest. The third way to invest is definitely known to everyone. That's called lump sum investment. You put in some money, you wait for some time, you put in more money. If you don't have more money, it's okay. You can keep for 5 to 10 years, and money also grows in those particular times and ways. But the probability of making higher profits rises when you make a SIP. Moreover, I would suggest SIP as a disciplined way to invest. By discipline, I would mean, supposing you have some income coming to you, you can invest some money and use the rest of the amount. Next month, you can invest a similar money into the funds and you can use the rest of the amount. So every month when you invest, you are also called as a disciplined investor. And if you keep doing it, even if the market goes down or up, over a period of time, wealth is created. I'm not allowed to speak on the the percentage gains that you are likely to make, but equities in general have been giving a very decent return for the last 20, 30 years. That's beating the real estate index, beating the debt index, and of course, beating the gold and the silver indices. So have faith in the system, have faith in India growth story that's happening, that's visible, and you can always put some money into mutual funds in a SIP way. I think that's it from my side. Can we have any questions or any other topic that Astha you can understand and let me know? I can speak on that.
Just checking out the questions. Mm. We don't have any question from the audience side, though.
Okay.
Mm. So thank you, sir, for sharing this great knowledge that you have. You have this great experience. So experience speaks itself. Thank you so much.
Thank you.
So to move ahead with our session, we have CA Srikumar Menon, who is going to take up us through the micro and macroeconomic picture under the Buffer ratio and the Golden ratio. He's a chartered accountant and has been a stockbroker since 1988. He has done courses on investment analysis and portfolio management from Indian Institute of Management, Ahmedabad, and Management Development Institute, Gurgaon, New Delhi. He served as the chairman of Messrs. Cochin Stockbroker Limited, which is a subsidiary of Messrs. Cochin Stock Exchange Limited, till September 2012. He was on the board of Cochin Stock Exchange Limited and was a treasurer of Stock Exchange in 1992. He has also served on various committees of exchange such as chairman of Arbitration Committee, ID Development Committee, and many more. He was on the board of studies of the Commerce Department of Sacred Heart College, Thevara. He's on the board for that in the past. He's on the board of Messrs. Datamate Software and Export Private Limited and Datamate Info Solutions Private Limited, which is in the process of getting listed on SME Exchange, having its offices in the SEZ, Kannadu, Kochi, Trivandrum, and Dubai. So that is the company that is in the process of listing. He has a stock broking firm, Messrs. Srikumar and Company, which deals in the National Stock Exchange and Bombay Stock Exchange in both of the cash and future and options segments. He is the managing partner of Messrs. Finwest Consultancy, which helps raise pre-IPO funds, placement of shares, etc. He regularly addresses seminars on investments and teaches at the Institute of Chartered Accountants of India for their various courses. He also previously addressed students as a visiting faculty and is a guest of speaker at several colleges in Kerala. He brings to us over 35 years of experience in capital market. Over to you, sir.
Thank you, Astha, for the introduction. Is it possible for me to share my screen?
Yeah, sure, sir, you can.
So, first of all, let me thank and congratulate Navneet Singh Bakshi for a nice exposition on mutual funds, which I won't be talking about because that is entirely different from what I'm talking about. So let me go and just share with you my screen. One second. Yeah, hope you can see it.
Yes, visible, sir.
Yeah. So basically, people do talk about markets. They talk about a lot of stuff. I thought it would be necessary for us to understand as to why should we be doing all this. First of all, even though I know I'm basically addressing chartered accountants, if the fundamentals are not there, why are we doing all this? People tend to get confused as to trying to make what we call a quick buck, or sometimes trying to do something which is not really rational. Bakshiji, in fact, said, if you do not have a 3 to 5 year horizon, don't try to go into equities. In fact, one of the reasons is that companies don't grow overnight and become massive. They take time. The management has to work, and you have to let them work so that they create the wealth that is necessary. And it just so happens that equities happens to be a one way. Mutual funds happens to be dependent on the equity market, but there are professionals to handle it. So for small investors, it's always recommended that they go through the mutual fund route. Of course, there are very big, large companies also who use the mutual fund route. But in general is what I'm just trying to say. And so I'll just start with my presentation, in which we are going to just do a small introduction. And I will try along the way, not necessarily very formally, but try to distinguish between investment and trading. Then we'll go to these two things we talked about, that is the Buffett ratio and the golden ratio, give some examples and come to a conclusion. So the fundamental question, like I started with, is what is investment? Now, typically we all go in for a job to try and make some money. Chartered accountants also tend to go in for practice, again, to make some money. There are others who do businesses, they do various things. But it means basically using your time to make money. So investment, on the other hand, should mean that it is your money working for you rather than you working for your money. So I start with this traditional example of asking you to understand the power of compounding, which means chartered accountants do know that, but I would still, we are in a presentation. Just mute that. So suppose I were to offer you two cash flow streams, which is 1 paisa per day, which doubles every day. Okay. Meaning that if I give you 1 paisa today, it becomes 2 paisa tomorrow, and 4 paisa the day after, 8 paisa the day after, and so on. But this offer is there only for 30 days. The other cash flow stream is I give you 1 lakh today, 1 lakh rupees. I give you 1 lakh rupees tomorrow, again for the same period of 30 days. So which would you accept? Now, usually I do find that people take almost an equal kind of thing. Some people say 1 paisa means there must be something behind it. So I think I'll go for the 1 paisa. They are more of a speculative kind. The other is a very straightforward deal. 1 lakh per day for 30 days means 30 lakhs, and that's pretty good money. So let me take that. Well, the point I'm trying to make is not that. If you use a calculator, you will definitely get which is better. You would find that until the 29th day, the offer of 1 lakh per day looks pretty good, because on the 29th day, you're at 29 lakhs, whereas this 1 paisa would have reached about 23 lakhs odd, or 26 lakhs odd. Whereas on the 30th day, the picture suddenly changes. The 1 paisa doubling every day becomes 53 lakhs odd when compared to 30 lakhs for the other option. So those who had selected 1 paisa without knowing obviously were correct. But is my point to show that I know how to use the calculator and you don't? That is not the point at all. If you look at the life of a person who works for money, the period you can say is approximately 30 years. So suppose you could start with 1 paisa today. Next year, by this time, if you had made that 2 paisa, you're on track. Year after that, the same time, if you made it 4 paisa, then you're on track. Like that, if you can do it for 30 years, then should you not have 53 lakhs rupees in your hand when you started with just 1 paisa today? So that is the logic. So in that case, what happens is, if you check your purse now, you'll find it's far more than 1 paisa that you're holding. You multiply each paisa with 53 lakhs. That's a fairly huge sum to talk about. Then what do you have to worry about retirement, etc.? So this is the basic premise on which we should do investment. And for that, the earlier you start, the better, because time is a major factor. But what about for those people who are, not that young, they're already reasonably old? Then you have to think about the rate. If you can improve the rate, fine. Otherwise, the targets that we talk about may not really apply. Then the question comes, why should we do all this? So it is actually saying, when you actually retire, you will find that probably you're getting the highest possible salary or income that you can till then. And then after retirement, what usually happens is you tend to get paid. If you're having what is called a pension, you tend to get paid about 1/3 of what you were earning in your highest point. And which means the lifestyle automatically changes. Quite often, just to maintain the lifestyle the person is used to, they have to go and find another work to do at an old age where they should actually be taking it easy. So one of the reasons could be to provide for your future when your main productive years are over. The second one is, I would say there are planned and unplanned heavy expenditure. Wedding, children's higher education, etc. are planned. The unplanned one is like, suppose you get into the bathroom and then your spouse or somebody had an oil bath and you slip and fall on the floor, you might end up with a broken hip. And that costs you maybe, I don't know, nowadays it might cost you about 10, 15 or 13 lakhs. And that will usually wipe out a fairly large amount of what we call PF and those kind of benefits that you apparently got when you retired. So this part is also taken care of if you have provided for it by beginning your investment early enough. The other method could be to invest in wealth generating assets, means those assets tend to generate more. That does not mean buying an expensive car or a big bungalow. It depends on the wealth that you want to generate. It usually means businesses. Then obviously the last one is like you to lead a value-based and comfortable lifestyle. Just because you don't have money, you compromise on a lot of things. You don't have to do that. So these are the whys. When should you start? The answer is, I would say yesterday or something, if not already started. Now, if not already started. Earlier the better. And in that, the time is the key to compounding. Because like I said about my earlier example, I took the time of 30 years. If you had the vision of 30 years, at least those who are listening, if some of you are young enough to have another 30 years left, then definitely time is a factor you have to consider and you can think. Second item you consider is the rate at which the compounding is done. Higher the rate, the better it is because you can get a better result. But then, of course, the problem with that is risk and reward are correlated, especially in equities. You take higher risk, then your reward can be higher. It can also be negative correspondingly. So you have to decide on the rate you want based on your risk bearing capacity. So that is one factor you have to keep in mind. Then, is it that equities are the only avenues? Not at all. There are so many, avenues of investment. For that, the first one that comes to mind is real estate. Everybody knows you buy property, you buy land. It does not depreciate because the number of people in the world in India keeps on exploding. We recently went above the figure of 142 crores and we beat China in the process. We are the largest, most populous nation in the world. So that being the case, when real estate is, only so much and the number of people are increasing, it has to go up and the demand has to go up. So there's no problem in investing in real estate. The only big issue is the question of liquidity. Liquidity means converting your asset into money or cash or vice versa. Now, real estate, the problem is whenever you want to sell, it's not easy to dispose it of. So that is one of the biggest negatives we can say. The others are like, there is another category which we call nominal assets, which include shares. Bakshiji, he just mentioned about mutual funds. It could be fixed deposits. Some people invest even in derivatives. Some people invest in life insurance. And then you have this new thing called crypto, which is not really an asset, but people call it an asset. So all these things are there. Then there are businesses. Now, businesses are ideal to invest. The stock market is a device where you're allowed to invest in a business if you see it so. You can also take it as some like kind of thing where you just speculate. But basically, you're taking a portion of business when you invest in shares. And if you invest directly in some business, that is also good because they tend to generate wealth. Then the startup ecosystem is there, which means somebody has such a bright idea that is going to change the way people look at things, and you get a huge amount of profits right in the beginning. But the problem with startups is the ratio of failure is extremely high. They say it goes up to 89-90%. So there's a good chance that you might lose your money when you invest in a startup because they usually don't have the basics correct. The other area could be commodities or currencies. Is another thing. Like, for example, I know when the Kuwait war started a long time back, when Saddam Hussein was alive, the Kuwait currency just fell down. Kuwaiti dinar fell down very badly. And I remember some people from my state, that is Kerala, who were based there. They bought up a lot of Kuwaiti dinars at some 30 rupees, 35 rupees, 25 rupees, etc. And the war just lasted for barely a month. Immediately after the war was over, the price went back to 110, 150 and all that. And they made a quick pile on that. So that is called a little speculation, but they judge it rightly, I suppose. So that is one way. The other areas would be art. Art is because, it's not usually multiplied easily. It's all specialized stuff. one painting that is created is not duplicated as such. Then you have this new age stuff called non-fungible tokens, where all the mega superstars, etc., they take something and they say that this non-fungible token represents that, and that is also there in the market. And if it is unique, the price tends to go up over a period of time. Then there are things like stamps. This picture that I put is that 1 penny stamp, Ming vase. These are all rare items, and if you happen to invest in such, of course, the liquidity part is there. It has to be probably sold through some auction house and all that. They will take a fairly large cut, but still, these are items you can invest in. So we call something called fundamental. And I give this example, and this is actually an old example. This company called Maruti, they introduced this model called Swift about 25 years back. And at that time, it was considered to be one of the most modern cars that is being bought out. Even from the Maruti stable, it was a brand new, newly designed car, with the result that there was a massive booking period. I think we are seeing a similar booking period for Toyota's new Hycross and all those vehicles. The booking period, waiting period went up to 9 months. And incidentally, for Toyota Hycross and all that, I believe it is about 2 or 3 years. So that's even worse. But the point is, to illustrate this, there is a value, say, let us say it was 4 lakhs at that point of time. And it's supposed that in your family, there is a wedding, the daughter or somebody is getting married, and the father wants to present a Maruti, Swift car as a wedding gift. So that is non-negotiable. It has to be done. So with the result that, suppose the wedding is just 15 days away. And when you go to a Maruti dealer, you find that none of them are able to supply because the booking is too large. The number of people are too thick. So then he might say that since you want it so desperately, I'll do one thing. I'll give it to you at what is called a premium. So instead of 4 lakhs, he says you pay 4,75,000. Then you can get my friend is booked. He might decide to forego that and take your money. So he will be willing to sell it at 4,70,000, 75,000. Are you willing? You say, okay. And then the deal is done. Now, my question is, did the father get a better car when he paid 4,75,000? The answer is no. Similarly, then the Maruti car company decides that if this waiting list keeps on being held there, a lot of people are going to cancel and they lose out on the whole deal. So therefore, they increase production so much that in the next few months, they cover the 9 months waiting period, and then they also actually give excess cars to all the dealers in that locality. Then what happens is, now Diwali is around the corner. These people are stuck with at least 100 cars each, and they want to somehow sell it. They come out with an offer which says, look, Deepavali discount, we'll give you at 75,000 rupees less. Probably you are a smart person at that time and decide that, look, this car is a good car, I'll buy it at this price. You probably got it at 3,25,000. Now the question is, did you get a cheap car? It was the same car, but it was a cheaper price. So in the fundamental analysis, if you're able to find out what is a value, and the prices tend to fluctuate because of various other reasons, this graph shows how the prices move against the true value. If the price is high, like I said in the earlier case, 4,75,000, you might decide to sell. Similarly, when there is a sale in the market, you might decide to buy. So that is called buying and selling based on value, not on price. Okay. So you have to find out what your factors, what are your requirements. So you have to consider your age. The older you are, they say that it is normally not correct to take too much risk. But then risk is not a general thing. It's based on a profile. Some people are, even though they may be old, they may be willing to take higher risk. Some people, even though they are young, they may not be willing to take risk. So it depends on the risk profile. Similarly, the nature of the investable surplus. Investable surplus is something which you can put it away and not really worry that, when will I get it back thing because I need to do something else. So that is the kind of money you have to invest. So some people, and along my career, I have met people who have come and said, my daughter's wedding is 6 months down the line. Can we do something with that money? I usually tell them, don't do anything with that money. You keep it in some fixed income security so that you can take it when you want. Don't take any risk on that. Objectives of the investment, are they talking about long-term or short-term or something like that? You have to take a call. Then the liquidity needs is how fast do they need to convert these things into cash and vice versa. And then you can consider what is called a portfolio approach. In the case of mutual funds, that is what they do. They spread it across a number of shares so that in the event that a particular share does not do well, the others will compensate for the risk. Then we have the standard thing, which is an old thing, which we call the 100 years rule for equities. You consider your age, deduct it from 100, assume that you live to 100 and deduct it from 100. The balance, you take it as a percentage of your investable surplus, which you can invest in equities. To give you an example, suppose your current age is around 40. From 100, if you remove 40, you get a balance of 60. So you can say that 60% of your investable surplus can be put in equity at that age. But then suppose later point of time you have become 65, then you'll find if 100 minus 65 is 35, then of your investable surplus, only 35 should be kept in equity. This is just a general rule, nothing special about it. It takes into account the fact that your risk appetite will go down. Okay, tax planning, as we say, chartered accountants, I need not talk about this. The only thing is tax planning is not tax avoidance. If returns are high, we prepare to pay taxes. Then these are the exemptions where it's available, etc. Now, coming back to the time value of money, I started by saying that you can, if you double your, return, 1 paisa becoming 2 paisa, becoming 4 paisa, etc. What do you do? So I give you this question. Suppose in 1993, it's a little early. There are youngsters who are not born at that time, but still I'm saying, suppose you had 9,500 to invest in 1993. What should it be worth today? We considered various aspects of investment. If you had put that money in land, if you take, say, probably 1 cent of land, what would be worth today? And depending on the place, it would have gone up. Maybe the maximum amount you would get is about 20-25 lakhs. The other one would be, suppose you put in a fixed deposit in 1993, the interest rates were high. So we probably would double in about 5.5 years. Indra Vikas Patra used to double those days. So you would have about 1.5 lakhs or so. And similarly goes on for that. But on the other hand, suppose you had the sense at some time at that time and somebody told you that there is a company called Infosys, which made the public issue at 9,500 and it was not even subscribed because nobody knew who Nandan Nilekani or the promoters who they were, nobody knew about it. And therefore actually it quoted less than the issue price after the issue was over. You could have bought 100 shares with 9,000 because it was issued at 95 rupees. Now, what would that be worth today? You can look at Infosys. It would be worth 15.47 crores, giving an simple annualized return of 54,289% because they gave 8 bonuses and 2:1 split. And the figure goes to a pretty big thing. Remember, I was talking about 100% per annum. So I was just showing you that there are cases where such things have happened. Pidilite is another example, which was 140 in 1996. Now I think it's around 580. Again, they gave a number of bonuses and a 10:1 split, giving out 2,570 per annum. There was a Kerala company called Manappuram General Finance. They gave 3 1:1 bonuses and 5:1 split, which gives about more than 800% per annum. And of course, Praj Industries is the one that takes advantage of the ethanol story. It was 13 rupees in 2003. Now it's 66 after 2 1:1 bonuses and 5:1 split, giving an average return of 846% per annum. So like that, we have massive. This is another huge story called Wipro, which had you or your parents decided to invest in 100 shares in 1980, paying about 10,000 rupees, it would be worth 846 crores at the current market price of 440, whatever. So you can see this is a list how they gave bonuses. 1:1 bonus for 81, 85. Then there was a stock split, which reduced the face value. It made it 1 rupee. Then 87, 89, 92, 95, 97, 2:1 bonus. And again, the split was there. So all these things put together would have increased your 100 shares to 1 crore 92 lakh shares of face value 2 rupees. With the result that the amount of that 10,000 is worth 840. This is mind-boggling. It's not that every share does this, but then if you manage to identify and you manage to hold, that's a very important point. That is why I agree with Mr. Bakshi, who said unless you have a 3 to 5 year horizon or more, it doesn't make much sense to just simply sell off because you got some profit. So you have to have, they need time to perform, and that is why we talk about long-term investing. And there is a negative aspect of short-term trading. A lot of people think that trading and investing are the same. It's not true. Trading usually means you're doing a short-term thing, and then you're subject to a short-term capital gain of 15%. If it is done within 1 year, it is 15%. And therefore, each time you churn, the government takes away 15% of your money, and therefore your returns are diminished by that 15% each time you churn. So you have to be like the farmer who plants, say in Kerala, we have this thing called rubber, wherein the rubber sapling is put and then they wait for 7 years, look after the whole thing, and then they get the rubber sap. Or a coconut sapling, it takes another 7 years, then they get the nuts forever. So like that, you have to be willing to let your company grow like these perennial companies, perennial plants, But remember that even though I may say all this, if the general sentiment is weak, then good performance will not be appreciated. So we say that during a high tide, when there is a high tide because of the moon, all boats which do not have a hole will rise. Similarly, when it goes to low tide, you'll also see it fall. So these are the two aspects you have to consider, So therefore, there is a need to assess the broad and short-term movements as well. That is where we get into a little bit of details, because without this broad, the movements to understand, that is where this Buffett indicator, which has been, of course, the spelling is not right. It is BUFFET. Buffett indicator is used to understand the broad movements. And there is another one which we talked about in the title, which is the short-term movements can be taken with the golden ratio. Technical analysis is what you do to try and understand the movements, etc. It is not really necessary unless you're going in for some micromanagement. So it is like trying to do the investment part in the short term. That is what technical analysis is. And that is not an easy thing, because you'll always find that you missed out something, and that can be a problem. Here's a chart which shows in America, if you had invested $10,000 in the Standard & Poor's 500 index from, say, January 2003 to December 2022, they've covered. They found out that had you just stayed invested, you did not actually did a churn or did not buy, sell, all those things you didn't do. You just stayed invested on all days, you would find the value $64,844. Whereas in this period, that is almost, it's almost a 20-year period. In this 20-year period, you just missed out 10 of the best days. Either the market fell down and bounced or whatever, you just missed it out, and you try to trade all these things. The return goes sharply down to less than 50% at $29,708. If you missed 20 of the best days, the return even goes down further to $17,000. And 30 days, 40 days, and 60 days shows that it goes into a minus figure, So it is just to tell you that you shouldn't try to play the market on a regular basis. Now, some people do that, saying that it's like playing cards. What can I do? I'm addicted to it. But here I would say it is not right. You should try and understand that it doesn't pay to try and play the market on a regular basis. It's a huge waste of time. This is my reading, because I've done it personally. So again, I'm able to tell you. Now let us come to our major, which we said Buffett ratio for valuation of the market. Well, it's a simple thing. You take the total stock market value, which means every share multiplied by the corresponding market price, that we get what we call the market cap, and you divide it by the GDP. GDP is gross domestic product, and you get this ratio called Buffett ratio. It is named after Warren Buffett, who said it is the best single measure of where valuations stand at any given moment. And why I put this at this point of time is a lot of people have a doubt regarding, are we overvalued? Are we at a stage where all these things can come crashing down? If so, what should we do? Now, these are the questions that I usually ask, and that is why I've decided to talk about Buffett ratio. Now, in the US, just to understand, they say it is a total of United States stock market cap to the GDP. So they've taken this figure as on August 31st, 2023. That is just last month. It is aggregate US market value is $47.94 trillion. What is a trillion? It is 1,000 billion. What is a billion? It's 1,000 million. And what is a million? It's 10 lakhs. So it's a massive figure. Okay. But their GDP is only at 27.04 trillion as of last month. So what happens? You take 47.94 divided by 27.04 and you get a figure of 177. 177 is, they say it's already 47.02% higher, or 1.5 standard deviation over the historical trend line, suggesting that the stock market is overvalued relative to the GDP. Now, this is a dangerous thing, because while we might say India is doing pretty well, but if the collapse takes place in the US, it will definitely affect India. So that is something you have to keep in mind. 177 is way higher. Okay. But what about India? The stock market, they say, is if you take the original indicator, that is market cap divided by GDP, they say it is currently at 97%. It is not yet equal to GDP because we are growing continuously. The maximum we have hit is nearly 120%, and the low is 58%. What Buffett says is if it is around 80 or less, the market is undervalued. If it is 115 or more, market is overvalued. So you can expected future rate is taken as 6.6. Now they have tried to change this ratio instead of just the total market cap divided by GDP. They have added along with the GDP at the denominator, total assets of the central bank also. Even if you take it that way, the denominator being larger, still the stock market is considered to be fair value, which means you're not taking a massive risk of investing as of now. Okay. So the ratio of total GDP, market cap divided by GDP plus total assets of central bank, the recent 10-year maximum is 101.79, whereas earlier the other ratio it was 119.68. The recent 10-year minimum was by this ratio is taken as 51.53, whereas the earlier one was 58. And the current ratio is not 97, it is 87 based on the new formula. And the modified expected future annual return is 6.5% against 6.6%. So we are more or less in the same area. It's not that it is very tough or something like that. It's pretty good. Now, why is this total assets of central bank added to the denominator of Buffett ratio? The reason is given here. To account for the monetary policy of the country, the central bank's assets are used to control the money supply and interest rates, which can have a significant impact on the stock market. For example, in the US, because the interest rates shot up because of the loose money policy, some banks actually went under. So such central banks decide all these rates. So their assets are also something important because they use it to control money supply and interest rates. So by adding the central bank assets to the denominator, the Buffett ratio provides a more accurate measure of the stock market's valuation. It helps to account for the impact of monetary policy on stock market and provides a more comprehensive view of the market's valuation. So this is the reason why the second ratio was modified. I mean, the original Buffett ratio was modified to give a more clearer picture. Sorry, did somebody say something?
So video is not visible.
Acha, just a second.
Screen is visible.
Yeah.
You're on video.
Acha, my personal video. Okay.
Yes.
1 second. Yeah, is it clear now? Yeah. Okay. So the market index for this, now these are details, like how did we work out these things? The BSE Sensex was used. Similarly, the annual GDP is taken at $3.2 trillion, and then corresponding figure in Indian rupees is also given. And the total assets of the central bank is taken as $373 billion US. And the data taken is from the year 1997. This is just for us to, on what basis did you come to this figure? This is the reasoning given. 1 second. Then, as far as India's historical GDP is concerned, it has grown at the rate of 7.18% for the last 8 years. And it does not include the effect of price inflation and is not the real GDP growth rate. Okay. And this is already repeated here. So, the Buffett indicator expresses the value of the stock market in terms of the size of the nation economy. If the stock market value grows faster than the actual economy, then you are actually in what is called bubble territory. And then you have a sharp fall when it is realized in the market. It can be triggered by various aspects, like it may be some small reason, like in the 2008 crash started by giving us indications. In fact, I had given a talk in which I said market is going to come down in a big way, but I didn't expect it to fall so much. Wherein one of the indicators you should look out for is all the good quality shares tend to be very highly priced. Then the market looks for what next. Then they go for what is called a mid-cap stock. They also tend to go up very high. Then the last part is when the small cap and micro cap stocks tend to go up without any particular reason other than a lot of stories in the market. And that is when you find that nothing is buyable. And all these things, then they tend to go down. The bubble bursts. And you'll find the first to fall will be the ones who came up last. So that's the danger as far as this bubble part is concerned. Then this Buffett indicator, here we have these strongly undervalued vis-a-vis overvalued kind of scene, wherein you can see when it goes one standard deviation above the historical trend line, we say it is overvalued. It goes 2 standard deviations strongly overvalued. Same is applicable on the minus side. If it is 1 standard deviation below the historical trend line, then you say it is undervalued. But if it goes 2 standard deviations, then it is strongly undervalued. And if what I said earlier was, as far as US is concerned, at 177% ratio, it is 1.5 standard deviation above the trend. So it is definitely going towards strongly overvalued. So we can expect that kind of fall. They'll give you various reasons. This is the reason why it went down, etc. But the fact of the matter is, it is overvalued already. So while we may say we look undervalued, you can expect some shocks as far as the market is concerned because of these reasons. Now, if you look at the original ratio indicator, we have below less than or equal to 63. It means the valuation is significantly undervalued. If it is between 63% and 81%, it is modestly undervalued. If it is between 81%, we are talking about the total market cap divided by GDP. That is the ratio. So if it is between 81 and 99%, it is called fair value. And then, of course, the last part is if it is over 170%, it is significantly overvalued. Now, this is not a static number. Please remember that. It is always that the GDP grows as well as the earnings grows. So therefore, this ratio will keep changing. Currently, as on 23/9/2023, that is, I think today's date is today. Yeah. Today's ratio is 97.01 as per the original Buffett ratio. And that is placed in that between 81 and 99%, which is called fair value. Which means if you're getting into the market today, don't worry that it is too highly priced and all that. They're saying there is a lot of scope. Of course, you're choosing the script also matters, right? The second modified ratio was what? It is given there. Ratio here is total market cap divided by GDP plus total assets of the central bank, which means the base becomes larger and therefore the ratio will also be correspondingly lower. So here they say if it is below 56%, it's significantly undervalued, etc., etc. And if it is above 104%, it is, for the total assets of central bank also coming into the picture. So it is significantly overvalued. And here we are at 87, which is actually between this ratio, it is fair value. So this is and gives you an idea that as far as the Indian market is concerned, even now we are doing reasonably well. There's no problem because a lot of fundamental changes are taking place. You should realize that it is not the old India that or the Bharat that we are talking about. A lot of changes are taking place. The latest being there is something called ONDC in the pipeline. You may have heard of UPI, that is Unified Payment Interface. That has created such a massive change in the way business is done. Everything is done now through the bank. And in fact, last month, the figure was, as per the papers, 1,000 crore transactions. That's a massive figure. It's the largest in the world. So what UPI did was it took away the importance of just currency or transacting between them and made it cheap. Now there is a talk that there are already some 15 countries, including France, which are willing to use the UPI. And I believe in the coming months, even from USA, you will find that payments are being made through UPI. So ONDC happens to be a similar initiative wherein the e-commerce part is going to be countered by ONDC, making it easy for small players to take part in that. And that will again have a massive impact, which I believe. Otherwise, what happens is you find these major players are taking too much advantage of and the bulk of the profits, etc., will go to them, and then you will have a social unrest problem. So that is being taken care of. So what is said here is, see, this Buffett indicator is a useful tool to evaluate whether the stock market is overvalued or undervalued. But there are some potential risks and limitations. For example, what does it not consider? It does not consider interest rates. It does not consider geopolitical events. Like, for example, there is something going on right now between Canada and India. Now, does it have an economic significance? That is not considered by the Buffett ratio. Or other economic factors that could impact this, the raw war between, say, Ukraine and Russia. So all these have an economic significance for India, and that is not considered here. So you should not use only this indicator as the only, even though Buffett said it's a very important thing. It's an idea, like where do I stand? That is the idea behind this whole thing. Therefore, investors should not rely solely on these indicators and should use other investment strategies to make informed decisions. This is the caveat that is put across there. As far as GDP projections are concerned, our GDP is expected to rise from 3.74 trillion in 2023 to 7.3 trillion in 2030, which shows a growth of around 10% per annum. And with the result that we will exceed the Japanese GDP by 2030, making India the second largest economy in the Asia Pacific region. And by 2022, we have already become larger than the GDP of UK and also France. So by 2030, we will also forecast we will also surpass the Germany GDP. So that makes us a very big country to be reckoned with in the international level. As far as Nifty is concerned, it could hit 39,000 by 2030. Okay, the current 20,000 levels it can go to in 7 years' time. 39,000 is there, and we assume for that in the Buffett index the composition and weightage of the component stocks are the same. See, there is a tendency for this to be changed in between. That is there. But the biggest thing for me is the last sentence, which says Indian GDP for the year 2047, that is 20 years from now, has been projected at $30 trillion. Now, 30 trillion is bigger than what USA has now. So if that is so, the kind of wealth at 30 trillion, we are talking about 2,500 plus lakh crores as India's GDP. If that kind of wealth and assets have to be created, you definitely have to be with the companies that will be part of this game. That is why investing in equities, because from $5 trillion by 2027, if you're going 6 times in the next 20 years, you should definitely be a part. That is where you're going to make a kind of money you've never seen. And what I said earlier about certain companies is going to be true for a new set of companies, or maybe the same companies which have got a monopoly in India. So that is why this Buffett index would be considered important for that purpose. Now let us come to the next part, that is the golden ratio. I put this number 1.618. Now there is a specialty regarding this golden ratio because it is found virtually everywhere. Golden ratio, also known as golden number, golden proportion, or divine proportion, is what? It is actually a ratio between two numbers which gives you approximately 1.618. And it is usually written on the right side is a symbol that is spelled or pronounced as pi. It is strongly associated with the Fibonacci sequence, which is a series of numbers where each number is added to the previous number. Okay? And you get a Fibonacci sequence. So let us see what is that. Okay, this Fibonacci sequence was discovered or named after Leonardo of Pisa. You heard of Leaning Tower of Pisa. So that person was known as Fibonacci. He introduced the sequence to the Western European mathematics in this 1202. It's not a very recent book. It's a very old book called Libere Abaci. Okay, in that he introduced these numbers. So what is special about these numbers? See, the Fibonacci sequence works like this: 1 followed by 1 followed by 2, 3, 5, 8, 13, 21, 34, 55, 89, etc. How do you work it out? You start with 1, you add 1 as the previous number, you get 2. The one previous to number 2 is 1, so therefore you add 1 plus 2, you get 3. The number previous to 3 is 2, therefore you add 2 plus 3, you get 5. The number previous to 5 is 3. It should be 4, right? But anyway, sorry, it is 4 there. 4 plus 3, I don't know if they put 8. So like that, you add these. I think the result is what is added. I'm sorry. The result is what is added. So therefore, to this 5, you add the next one, you get 8. Like that, you get 13, 21, 34, 55, 89, 144, 233, 377. Like that, you can go on. So this number specialty is, if you take one result and divide it by the previous result, you'll get almost a common number, which is 1.618. Initially, it won't be there, but as we go higher in numbers, you will find that is happening. And this is a sequence that is there everywhere. Like you see, 1 by 1 is actually 1, then 2 by 1 is 2, 3 by 2 is 1.5, 5 by 3. Those numbers we are taking and dividing. It is 1.66, 8 by 5 is 1.60, 13 by 8 is 1.62, 21 by 13 is 1.61538, 34 by 21 is 1.619, and then 55 by 34 is 1.617, and then you find it reaches that figure of 1.618, which becomes a constant as the numbers increase. So this becomes a steady number. Only in the initial stages there is a variation because the numbers are too small. Now the point here is from 89 divided by 55 onwards, you will get this number 1.618, etc., which is a common factor. So what is so special about it? When you look at it, you can see that, you will find in the initial, in the left side, for example, here, we draw a box of sides each having 1. Then the next side, you say, you have that 1. And then the same thing is increased to 2, then to 3. You find it forms a spiral, which is found in nature. Okay, and let me go back. Okay, sorry. Yeah. So taking larger numbers here, we find that, okay, here it was 21. From 21, it can go to 34 and then 58. The same spiral continues. So you find that these are called Fibonacci spirals. This happens in nature like this. Here, what is said is the unique properties of the golden rectangle, which is what we saw earlier, provides another example. This shape, a rectangle, which, one second, yeah. A rectangle.
The screen is not shared anymore.
Is it? Oh, I'm sorry, just a second. You're not able to see the screen?
No.
Not at all, I'm sorry.
It's visible. The screen that is having a heading shells is there.
Yeah. That's what I thought. Yeah, you can see the same thing. Who said you can't see it?
I said.
Navdeep, others can see it. So would you just check your system?
For sure.
Did you get it?
No.
Okay,
I understand this paper series. Please continue.
Okay. So in this, we see that this happens in the case of shells, wherein a rectangle in which the ratio of the sides A and B equals the golden mean, that is 5, that 1.618, can result in a nesting process that can be repeated into infinity. So the spiral shell, which is actually there in nature, it forms due to this number, and it's called a logarithmic spiral, and it abounds in nature. Okay. So you will find another example in which this famous Fibonacci sequence is found in what is called sunflower. The seeds inside the center of the sunflower starts doing this kind of movement. One second, yeah. So you find it is there in the sunflower seed. Is that visible there? When there is some problem.
Yes, sir, it's visible.
Visible, okay. So the next slide shows it is there also in the petals of flowers. So that is something it consistently follows the Fibonacci sequence. For example, the lily has got 3 petals. Buttercups have got 5. Chicory has got 21. Daisies have got 34 and so on. So it appears in petals also on account of the ideal packing arrangement selected by Darwin process, as they say. Okay. And out of 360 degrees, it takes 0.6180 degrees is what they said. So this is also an interesting statement. My point was it appears ubiquitously everywhere. It is not as just a number or a calculation. It is there in the nature. When we look at nature, you will find it. That is a basic concept. Now, coming back to the sunflower example, the head of the flower is also subject to the Fibonaccian process. Typically, seeds are produced from this center, and then they migrate towards the outside to fill all the space. So, the sunflower provides a great example of these spiraling patterns. So you can see that in this slide, wherein onto the right side spiral, there is 34, onto the left side spiral, there is 21. And that is what is seen in the sunflower, the sunflower center portion. Okay. And in some cases, the seed heads are so tightly packed that the total number can get quite high, as much as 144 or more. And when counting these spirals, the total tends to match a Fibonacci number. So we saw the sequence numbers. No? All these can be visible when you do the counting here. So my point is, this is not a discovery of which came all of a sudden. It is there. It is there in the nature, and this is how nature does it. So the point is, if it is so ubiquitous, now again, this is an example of a seed pods in a pine cone. You know, especially if you're in a hilly range, you have these pines. They have cones, and then you have a pair of spirals each going in the opposite direction, and they tend to match what we call as this Fibonacci sequence. Like a 3 to 5 cone is a cone which meets at the back after 3 steps along the left spiral and 5 steps along the right. That's how they define. They say it happens. Okay. Similarly, it can also be seen as far as the way tree branches form or split. The main trunk grows until it produces a branch, which creates 2 growth points. Then one new stem comes from there, and it branches into 2, while the other one lies dormant. So this pattern of branching is repeated for each of the new stems, and they've given a plant name called sneezewort. Root systems and even algae exhibit this pattern. So you find here in this diagram, you have the stem, and then you find it goes to 2, then 3, then 5, then 8, then 13, which is exactly the Fibonacci sequence, if you're analyzing it in that fashion. Okay. Then even, see, it is not just limited to Earth, it is outside Earth also. Like, for example, if we talk about, what do you call it? I'm sorry, we just went back. Spiral galaxies follow similar Fibonacci patterns. The Milky Way, which we all know about, has got several spiral arms, each of them a logarithmic spiral about 12 degrees. In fact, if you look at the picture, you find that the earlier box which we had written is shown superimposed on that. As an interesting aside, spiral galaxies appear to defy Newtonian physics. As early as 1925, astronomers realized that since the angular speed of rotation of the galactic disk varies with the distance from the center, these radial arms should become curved as galaxies rotate. So they found that they don't have this, they say it should have a wind problem around the galaxy that is not there. And, they seem to be moving at a velocity higher than expected, which is a unique trait for the common sun. See, this is all meant for astronomers, but point is that Fibonacci pattern is there also. Okay. So this is, see, this box is superimposed to show what we saw earlier is there in such a hurricane, like we saw in the case of galaxy in a normal hurricane, which is a normal phenomenon, is appearing. So why am I giving so many examples? The point I'm trying to make is that this is something that occurs naturally. Okay. So even in the phases, they say it is there. That's another interesting conclusion that is drawn. 1 second, this needs to move. Okay, now the mouth and nose are positioned at the golden sections of the distance between the eyes and the bottom of the chin. I mean, these are all details. Basically, you will find that that box is following the same pattern. Okay, and this is just interesting for those who are concerned with beauty. They say that the more closer our proportions adhere to 5, the more attractive those traits are perceived. As an example, the most beautiful smiles are in which central incisors, that is your teeth here, are 1.618 wider than the lateral incisors. Okay, so you see, this is even the perception of somebody is beautiful comes apparently from this number. That is what is being said basically. So it is a potential indicator of reproductive fitness and health. Okay, so having said that, that is phases. Then we have honeybees. Okay. Honeybees, they follow Fibonacci in other instances. The most profound example they say is by dividing the number of females in a colony by the number of males, because females always outnumber males in a bee colony. And what has happened? This is also very close to 1.618. The family tree of honeybees follows a similar pattern. Males have 1 parent, a female, whereas female can have 2 parents, a male and a female. So then when it comes to a family tree, males will have 2, 3, 5, and 8 grandparents. great-parents or great-great-great-grandparents, great-great-great-great-grandparents, respectively. Or if you look at the female side, females have 2, 3, 5, 8, 13, and so on. So with the result that the B psychology follows the golden curve rather nicely. That is what is noted. Now coming to even, we went to the galaxy. Now we come right inward. DNA molecules, even the microscopic realm is not immune to Fibonacci. The DNA molecule refers to 34 angstroms long by 21 angstroms wide for each cycle of its double helix spiral. This is for those who studied science that our DNA form is in a helix kind of number. Now, what is an angstrom? It is 100 millionth of a centimeter. So this is the kind of number we're talking. It's so tiny, but you find that you divide this 34 by 21, you get their ratio as 1.619, which is very close to that 1.618. So the point I'm trying to make is virtually everywhere, including within yourself, outside in the galaxy, everywhere these Fibonacci numbers are so commonly thing because it's a what do you call golden ratio. As an explanation, Fibonacci ratios are derived from, as I said earlier, this is just a repetition. Each number is equal to the sum divided by the two preceding numbers. Fibonacci ratios are informed by mathematical relationships found in this formula with the result what? They produce the following ratios. That is, if you take 1 point whatever, you find 23.6, 38.2, 50, 61.8, 78.6, 100, 161.8, 261.8 and 423.6 are the ratios you get. Okay. So those are the mathematical relations you find. Now 50% is not a pure Fibonacci ratio, but it is used. Now I'm coming to our stocks. After having said all this, since it's a common thing, this is how it is used in the if you're looking at, say, technicals and finding out where your support and resistance are there, that 50% is not a pure Fibonacci number ratio. Otherwise, the rest of it is all Fibonacci. So when somebody says, look at the Fibonacci and decide where it is going to come, or where it is going to go, then this 50% is also used. Now the other historical factors, the Fibonacci sequence was not developed by that Fibonacci person. Instead, centuries before Leonardo Fibonacci shared it with Western Europe, it was developed and used by Indian mathematicians because the Indian mathematician Acharya Virahanka known to have developed Fibonacci numbers and method of their sequencing around 600 AD. Following his discovery, the other subsequent generations of Indian mathematicians such as Gopala, Hemachandra and Narayana Pandita referred these numbers and methods. So there is a fact that we did seem to know about this earlier, but we didn't know how to use it properly, that's all. It was discovered by us. Now coming to all this, having said all this, how does it affect us as far as buying and selling of stocks or anything for that matter, price-wise? Because this is relevant to commodities or anything else you want. I've taken the example of Nifty 50. How does it think? You find that here, for example, 12,430 was a peak. It had hit this number 100, okay, which is a base. From there, when it fell, you find that it came to the 50% level almost and took support. This was the Corona fall. Then immediately it recovered. It went back to, see, when it cut 61.8, you say it has taken support and you can take a call to buy at this point. It went up and then first went and hit this 127.2% from there, which was a resistance. You find it actually reacted a little bit. Then when it cut, it went to next level is 161.8. It went there. So in charts, this is automatically there. If you ask for Fibonacci lines, you'll get it. You can check it out by checking whether it follows a pattern. So it came down to 127, then when correctly hit 161.8, went down, and now it has broken beyond that. So here you can see how these Fibonacci numbers can be used for short term. Though I was earlier talking about long term, there is a method where when it falls, you don't know what happens. Suppose it goes down from here another 50%, what do you do? So you have to see whether the support is taken or not, and then get out of your positions if you're a kind of player who punts the market, okay? Though I don't recommend it, I'm just telling this for the purpose of knowledge, okay? Similarly, this is again an INFI price, which was from January 20 to the latest date. You find after peaking at this price, it has actually come down. And it actually hit that 61.8% thrice. Okay, and the recovery was, the The recovery was only up to 78.6, and then it came to this 50%. That's why I said 50%, though it's not a Fibonacci number, it does have a support and resistance kind of scene here. It took support at 50%. So we say, fine, it took support and then it went up. Okay. This is only for our learning process that we're talking about this, but it is better than being totally blind. Now, this is the case of Bajaj Finance, a share that usually trends very well. This is that fall during Corona, a sharp fall, and then it recovered all the way. But when you find it hit 161.8, it's not able to move further. Always it comes somewhere there and goes down, or comes there and goes down. So if you see this, you can think, okay, why don't I take my money off the table right now, give the share and take it, because the pricing is high. And we already discussed on the Buffett ratio that though our price is fair value, the markets such as US and others are overvalued. And the unfortunate part you should know is that as far as institutions are concerned, the American or the other institutions are concerned, they usually invest in these high quality shares like Bajaj Finance. So whenever there is a fall there, you might find a follow-up selling here because of that. And this might be an indicator that, okay, if in case there is a sell-off, I'm not willing to take it further higher. That could be the reasoning. This is the case of Tata Motors. Again, we find the Fibonacci sequence there working out pretty well. It's, we find the 23 level was breached, then 38, then 50%. There was a small support here. Then went to 61 point. You find a couple of times it did not breach that. So it shows that the support was taken and then it went up. So it is possible to, understand what is happening in the market by watching these two indicators. One is overall, it tells you whether it is, worth it to try and enter now, or should we wait a little longer? So the thing is, investing creates long-term wealth. There's no doubt about that. This trading part is like, if you go and want to play, a game of cards, today you might make some money, tomorrow you lose. So in the long term, I don't know whether it really creates wealth for bulk of the people I understand lose money on trading. Okay, but investing, it is something they be, part of the whole story, which means this Henry David Thoreau gave a quote saying that wealth is the ability to fully experience life. So you have to have this idea that you need to create wealth. That is what was my introductory part, in which I said that this is the reason why we are trying to create wealth. So when you have enough wealth, you are able to fully experience life, which means you can, rather than say, I have to work, you can have a quality of life which you deserve. Okay. So having said that, what about, is there an example of anybody who has done this full time and really made money? The example is this person. We talked about Buffett ratio. I'm talking about the same person because he's well known in the world. He's the world's third man. He's got a net worth now of 122 billion US dollars, which in rupee terms is 10,12,600 crores. And he started to reach this figure, he started in 1954 with 10,800 US dollars. This 10,800 he made by actual physical work, wherein he went and did sales calls, and his sales commission amounted to this 10,800. From there, he turned out to be a very astute investor. He held on to shares for a very long time. And he doesn't unnecessarily sell it. That is not his habit. He doesn't just simply sell for the sake of selling. It's only not that he doesn't make mistakes. In fact, when Corona started, he was one of the few people who actually sold off all the airline stocks, saying that this is the end of the world, because nobody's going to be able to fly. But the airline stocks actually doubled within 1 year. But he missed out on that because he sold off. And he's not, if he sold, it's not a small quantity that he sold. He sold a very, very large holding. But it happens. But even despite all that, you find he's sitting on this kind of money. And remember, this 122 billion is after donating nearly 1/3 of his wealth for social causes. So had he held on to that also, he would have probably been the richest person now. So he's invested his major money in a share called Berkshire Hathaway, which was a textile company. And he has held on since 1954 or whatever. And it recently touched a high of $5,63,136 per share. Okay, which is the highest price share in the USA. I think in India it is MRF. It's about 1,06,000 or something like that. But we have this share, which is a $1 share, which is quoted at 5,63,000, because that is the kind, and he owns a major portion of that. That is why his wealth is so high. So this is the effect of investing seriously. So whether it is through mutual fund or whether it is directly, that is a choice that the person has to take. But the idea which Sri Bakshiji said, that you should have a minimum perspective of at least 3 to 5 years to start with, is very correct. Because you have to let your companies grow where you have part ownership. Even if you buy 100 shares, your part ownership is there. So that is something you have to keep in mind. So with that, I would like to end. I would definitely take questions if you have. Otherwise, that is my presentation. Thank you.
Thank you, sir, for taking up the session. So I'm just posting the questions that we got from the audience in the chat box.
Yeah. Well, I think one question that I see is, can Buffett ratio be applied to any particular share or stock to know its valuation? The answer is no, because the definition itself says we are talking about the market capitalization divided by GDP, which are not at all stock specific. It's entirely country specific. So it's a very broad ratio to understand whether the market is gone too high or not. Because some people have this doubt, should I wait for a correction? Should I wait? That is where you apply some things, what we saw about Fibonacci and other things on a micro scale for the index or the stock price. Of course, there are a lot of things. You have to look at the fundamentals and all that. But since my talk doesn't include analyzing companies right now, so we'll leave it at that. But the point is, no, Buffett ratio cannot be applied for a particular stock or share. No, currently, see, the other question that I see is currently Indian markets, are the current Indian markets currently overvalued as per Buffett indicator? That is why I said in my presentation, it is showed as fair value, which is about 97% as per the original ratio. And for the ratio that is, which includes central bank's assets, it is 87%. So that by itself is not in the danger zone. So there is steam left, and considering the fact that the Indian economy is well on its way to grow too good. So, I wouldn't really be worried. You see, the best part is if you take a high quality share, which the management is good, you can ride the fall in case there is a fall. If you have some more money, buy some more. Otherwise, just keep quiet. Just hold on. Typically, what happens is one small cycle will get over. Like if you look at Corona in March of 2020, the market went down sharply. But then you find all the blue chip shares recovered past the previous high within 1 year. So for that point, I would like to say that don't get too scared by a fall. It's not the end of the whole world. This stock market doesn't end like that. Okay? How do we know that from which point to which point we need to draw Fibonacci? See, typically I might look at, say, a fall and then a slight recovery. You want to know from there where it will go up. Then you draw your Fibonacci levels from there in the software that you use. Similarly, when you see a peak and it starts falling, from the peak you draw downwards, then you know where it can take support. So if it doesn't take support and goes down, you know that there's a bigger fall than expected. That's how you need to use it, on a price pattern. Some light on ESG related stocks or mutual funds. Well, ESG, I'm not supposed to talk about a specific stock or a mutual fund because it's only something which I'm supposed to be sharing knowledge. So I can't do any recommendation. But you're talking about social, ESG should be socially related something, So if you're planning to make money, forget about ESG part. Buy shares which make money for you. The rest of it is, I understand that ESG stands for some social stuff. No, is it? Am I right?
I'm not aware of it as well.
Yeah. I'll just check it up 1 minute. Yeah, it is actually environmental, social, and governance. That's what I thought. Yeah. So if it is, relating to environment, social, and governance and all that, it should not be making money, because social doesn't making money. So if you're investing in such a thing for social causes, think of it as a donation rather than looking at a return. Okay.
Yes.
So in that case, you can support it. I mean, if you don't mind parting with the money and not worried whether they'll make money, you do it. But if you're looking for returns, obviously ESG need not necessarily be the area to be in, because if it is too expensive, the business will not be there. If it is too cheap, company will not make money. So what's your point in trying to invest? I'm talking about in terms of investing. I'm not talking about the social aspects at all.
Right.
This is a different thing. It's like, see, you make 1 crore of money. Do you want to donate half of that to some charity? That is your choice. No problem. But first you have to make that 1 crore. No?
Right.
So for that, what you do is what I was trying to say. What you do with your money is your choice. Nobody is going to tell you what to do. You can decide. How to find a particular stock valuation underpriced or overpriced? Okay, that usually will be a part of another session at some point of time in the future. But typically what I might suggest is, first of all, you have to check certain qualities regarding management, the quality of numbers, whether they are fudging the accounts, and do they have a monopoly in the market. Without asking you to invest or anything, I'm just quoting it. It's not a recommendation or anything in any fashion. Nestle as a company is a well-known company. Okay. Now Nestle, I don't know whether you're aware, what is the specialty of Nestle as a company? What do they really, we know that they've got something called Maggi and all that. In fact, some time back, they had a problem with this Maggi product, and with the result that the price crashed. But the funny thing was, Maggi as a product only accounted for maximum 10% of their total sales. Their real sales came from their stranglehold in the baby food market. Okay, all this Nerolac and Nerelac, Cerelac and all that stuff is theirs.
Yes.
So when you have such a stranglehold, you have pricing power. You have the capacity to decide whether you want to make it higher, lower, or whatever. And they make money on that. So the price of Nestle had fallen to 5,000 rupees because of the fear of Maggi being affected by some controversy, whatever it was. Now, the price is around 23,000 rupees. It was 5,000 rupees sometime back when the Maggi problem came. So those who understood that would have said it is totally underpriced. Now, can you say that at 23,000 it is overpriced? It's very difficult, because I think at least around 15 to 20 years back, we used to say that we had the population of Australia every year. Okay. So that means newborns are always there. And newborns are the one who require this kind of food stuff, and they control 93% of that market. It means that you can't really expect that company to do very bad, because normal routine sales itself is very high. So this is how you decide. Sometimes you will find that certain shares, we talk about PE ratios. Certain high quality shares are quoting at seemingly high PEs of 40, 50, 60, whereas the market is quoting only at 25, 27 PE at the most. So is it overvalued? It seems to be overvalued, but the performance that they show is continuously they grow. So at any point of time you get it, you tend to make money. But the idea should be, in such cases, you hold on, grow old with such companies, because they've got that special edge over the rest of the people, right? If it's a technology company, I may not be able to say that, because always new technologies come. What seems to be good at one point of time will be suddenly bad at another point. There was a company called Moser Bear in India, which was the third largest manufacturer of CDs at one point of time. But what is the problem? CDs became outdated.
Yes.
So that company is gone. Nobody knows where it is gone. Kodak is another company which was considered to be fantastic as far as cameras were concerned and films were concerned. That is gone, because you have your cell phone with camera. Nobody wants to buy a camera and run around with it. And the film business went for a 6. So these are things we have to understand. You can't assume that one particular technological gain is going to be there forever. Always something new can come up. But in terms of Cerelac or food, actually you can't have new technology in that, in the sense that you can't replace that food item. It's something you eat. And the moment you eat in the morning, by afternoon you want to eat again. So that is a perennial business. That is the difference. Yeah.
So anybody having any other question can put that in the chat box. So we have one. we will be having this session recording on the ICI portal itself. You can check out there if you have missed it. Mhm.
I think that seems to be the end of the question, so that's fine.
Yeah, yes, I'm getting noise. Okay. Thank you so much, sir, for being with us on especially this Saturday evening. Thank you so much.
No. Okay. Bye.
Thank you, everyone, for being part of this session. Yes.
Thank you so much, ma'am. Good night, ma'am.